A single spreadsheet leaked from a boutique wealth management firm in Connecticut lists 27 individuals. Every name on that list has a net worth above $300 million. And every name on that list paid less federal income tax as a percentage of their wealth than the janitor who empties their office trash can. This is not a conspiracy. It is not fraud. It is not even aggressive. It is a strategy so mundane that it has its own nickname inside private banks, whispered across mahogany desks in New York, London, and Geneva. 3 words: buy, borrow, die. Those 3 words describe the most efficient tax avoidance structure ever built inside the modern legal system. It is taught in elite tax law seminars. It is printed in estate planning manuals. It is offered openly by every major private bank on the planet. And yet 99% of wage earners have never heard of it. The strategy does not rely on offshore accounts. It does not require shell companies in the Caribbean. It does not depend on any exotic jurisdiction or any clever interpretation of vague law. Everything about it happens inside the United States, under clearly written statutes, with full disclosure to the Internal Revenue Service. That is what makes it so remarkable. And that is what makes it so difficult to challenge. Tonight, we are going to take this structure apart piece by piece. We will follow the exact ledger entries. We will trace the loan documents. We will examine the tax code provisions that make it possible. And by the end, you will understand something uncomfortable. The tax system you pay into was never designed to tax wealth. It was designed to tax work. And the people who built it made sure their own assets would never touch it. To understand why this strategy exists, you first have to understand the fundamental asymmetry at the heart of the tax code. Income is taxed. Wealth is not. When you earn a salary, the government takes its share before the money ever reaches your bank account. Federal withholding, state tax, Social Security, Medicare. By the time the paycheck clears, something between 20 and 40% has already been claimed. This happens automatically every 2 weeks for your entire working life. The money is gone before it was ever yours to spend. But when an asset you own becomes more valuable, nothing happens. A share of stock that you bought for $10, now worth $1,000, generates 0 tax liability. The gain exists only on paper. Tax law calls this an unrealized capital gain. And under the current system, an unrealized gain is invisible to the IRS. This is the foundation. A wage earner is taxed the moment they create value through labor. An asset holder is taxed only when they choose to sell. And the wealthy have discovered something that changes everything. They never have to sell. Think about what that means. If you own $1 billion worth of appreciated stock and you never sell a single share, you have earned $1 billion of economic value, and you owe exactly 0 in capital gains tax. The gain has been realized in every practical sense. You can see it on your brokerage statement, you can use it as collateral, you can borrow against it. But because you have not pressed the sell button, the law treats it as if the profit does not exist. The reasoning behind this rule is historical. Early drafters of the income tax argued that taxing unrealized gains would be impractical because asset values fluctuate, and a taxpayer might owe tax on paper gains that later evaporated. That logic made some sense when most wealth was tied up in family businesses and farmland that rarely traded. It makes considerably less sense today, when a billionaire's portfolio is marked to market every second of the trading day and can be liquidated with a single phone call. This is the door that buy, borrow, die walks through. And once you see it, you cannot unsee it. The first move is buy, but this word is misleading because the real skill is not buying. It is never selling. The wealthy structure their portfolios around appreciating assets that generate minimal taxable income. Growth stocks that pay no dividends. Private equity stakes, real estate held through partnerships. Art, rare collectibles. Each of these has a defining feature. The owner controls the timing of any taxable event. Compare this to how a middle-class household holds wealth. Their main asset is usually a salary, which is taxed every pay period. Their savings sit in accounts that generate interest, which is taxed every year. Their retirement funds may be tax-deferred, but withdrawals will be taxed as ordinary income in the future. At nearly every layer of a normal financial life, there is a taxable event scheduled into the architecture. A billionaire's portfolio is the opposite. It is engineered to produce almost no taxable events, ever. Dividends are minimized because dividends trigger tax. Interest income is minimized because interest income triggers tax. Instead, the money is parked in holdings that grow quietly, silently, compounding inside the wrapper of ownership, year after year, untaxed. Look closely at the founders of the largest technology companies, and you will see this pattern repeated with almost mechanical precision. Their personal compensation, the part that would appear on a tax return as wages, is often set at symbolic levels. $1 a year, $10,000 a year. Figures that would not cover a month of groceries for a family of 4. Meanwhile, their ownership stakes in the companies they founded appreciate by tens of billions of dollars across the same period. The tax code sees the first number. It does not see the second. There are public records of this behavior. When a leaked set of IRS filings from several of the richest Americans was examined, one pattern appeared again and again. Their reported taxable income was often a tiny fraction of their actual increase in net worth. In some years, a multi-billionaire reported taxable income lower than a dentist in the suburbs. Not because they were hiding money, because the tax code simply does not see wealth that has not been sold. This is the first lesson of the strategy. If you want to avoid tax, do not earn. Own. And once you own, hold. The longer you hold, the more the system works for you, not against you. But here is the obvious problem. If you never sell, how do you spend? A yacht costs money. A private jet costs money. A home in 3 different countries costs money. At some point, even the wealthiest person on earth needs cash flow. And the trick that tax planners solved decades ago is the second step. Borrow. The mechanism is an asset-backed line of credit. A private bank looks at the client's portfolio, which might hold, for example, $2 billion of publicly traded stock. The bank offers a revolving loan secured against that portfolio, often up to 50 or 60% of its value. The interest rate is low because the collateral is enormous and liquid. The client now has access to, say, $1 billion of spendable cash. And here is where the tax code performs its quiet magic. Loan proceeds are not income. They are not taxed, not at the federal level, not at the state level, not anywhere. A loan is not a gain, it is a debt, and debts are treated as neutral. So the billionaire funds their lifestyle from loan proceeds, not from salary and not from sales. The yacht is bought with borrowed dollars. The jet is bought with borrowed dollars. The Manhattan penthouse is bought with borrowed dollars. Meanwhile, the underlying portfolio continues to appreciate untouched, and the loan interest is sometimes even deductible, depending on the structure. The numbers here are worth sitting with. Imagine a portfolio of $2 billion growing at 8% per year. That is $160 million of new wealth annually. The client borrows $30 million for living expenses. They pay, let us say, 5% interest, which is $1.5 million. The loan is serviced out of a smaller margin loan or refinanced against further portfolio growth. The net result at the end of the year. Wealth has grown by $160 million. Cash has been spent lavishly on personal consumption. And federal taxable income, in many cases, is close to zero. The IRS looks at this person and sees a retiree living on loans. The portfolio looks at this person and sees a growing empire. Private bankers market these credit lines explicitly. Promotional materials available in the wealth management sections of most major banks describe them in language that barely conceals the purpose. Phrases like unlock the value of your investments without triggering a taxable event. Finance your lifestyle while your portfolio continues to compound. Avoid disrupting your long-term asset allocation. The strategy is not hidden. It is a product sold to qualifying clients. And the qualification is simply having enough wealth to make it worthwhile. Before we go deeper, a quick note. If this kind of financial autopsy is what you came here for, the kind that pulls apart the machinery most people never get to see, consider subscribing. This channel exists to decode the systems that quietly shape who keeps wealth and who does not. Hit the bell if you want the next investigation the moment it drops. Now, back to the ledger. Now we arrive at the final step, and it is the one that transforms this structure from aggressive tax deferral into permanent tax elimination. Die. The word sounds grim, but inside tax planning circles, it is said without flinching, because it refers to a specific provision of the Internal Revenue Code. Section 1014. The stepped-up basis at death. This single provision is the keystone of the entire strategy, and it is the reason the first two steps are worth doing in the first place. Here is how it works. When a person dies owning appreciated assets, the tax basis of those assets, for their heirs, is reset to the fair market value on the date of death. All the unrealized gains that accumulated during the decedent's lifetime are wiped clean, for tax purposes, permanently. The heir inherits the asset as if they had just bought it today, at today's price. Think about what that means in the context of buy, borrow, die. The billionaire bought shares for $10 million decades ago. Those shares are now worth $2 billion. There is $1.99 billion of unrealized gains sitting inside that portfolio. If the billionaire had sold the shares during their lifetime, federal long-term capital gains tax would have been roughly 20% plus state tax plus the net investment income tax. Call it a tax bill approaching $500 million. But the billionaire did not sell. They borrowed, and then they died, and on the date of death, the basis on those shares resets from 10 million to 2 billion. The heir can now sell the entire portfolio the next morning and owe nothing in capital gains tax, not a reduced rate, not a deferred payment, nothing. The gain has legally vanished. The outstanding loans against the estate, they are repaid out of the portfolio at its stepped-up basis, which also does not generate a taxable gain. The estate is settled. The heirs walk away with assets worth billions, on which zero income tax has ever been paid. The tax authorities receive, on the entire lifetime of wealth accumulation, essentially nothing. The Joint Committee on Taxation has estimated the cost of this single provision to the federal government. It runs into the tens of billions of dollars every year, and the estimate grows as asset prices rise and concentrated wealth grows with them. Over a decade, the cumulative revenue loss from stepped-up basis alone exceeds $500 billion by conservative accounting. That is the price tag of the final move in this three-move sequence. This is not an exploit. This is not a workaround. This is the law, functioning exactly as written. At this point, you might be wondering about the estate tax. Surely the government takes a cut when this kind of wealth passes between generations. And technically, yes, the federal estate tax exists. But in practice, it has been neutralized almost completely. And understanding how reveals the next layer of the system. The federal estate tax applies only above an exemption threshold. That threshold has been raised repeatedly over the decades and currently sits at multiple millions of dollars per individual, doubled for married couples. But even above the threshold, the rate can be reduced dramatically through planning. Grantor retained annuity trusts, dynasty trusts, family limited partnerships, valuation discounts, charitable lead trusts. Each of these is a legitimate instrument, and each of them compresses the taxable estate before it is ever measured. Consider the grantor retained annuity trust, often shortened to GRAT. The wealthy individual places appreciating assets into a trust, takes back an annuity stream equal to the original value, plus a modest interest rate, and allows any growth above that rate to pass to the heirs free of gift and estate tax. When the assets inside the trust are volatile, and some appreciate dramatically while others do not, the winners transfer to the next generation at essentially zero tax cost, while the losers return to the grantor to be tried again in a new trust. Some families run dozens of these trusts simultaneously, in rotating cycles, for decades. By the time a sophisticated estate plan has done its work, a portfolio worth several $1 billion might produce an effective estate tax of a few percent, or, in some cases, close to zero. The instruments involved are drafted by specialists whose fees alone would bankrupt most households, and who do nothing else with their careers except engineer these structures. Meanwhile, the wage earner has no such options. Their wages are reported on a W-2, taxed at source, and settled in full before they ever see the money. There is no trust structure to hide behind. There is no valuation discount to claim. There is no stepped-up basis, because there is no appreciated asset to step up. The tax is paid in real time on every dollar earned, and there is no legal path to avoid it. This is the structural inequality that buy, borrow, die sits on top of. Two completely different tax regimes running in parallel. One taxes work continuously, with no escape. The other taxes wealth, occasionally, with dozens of escapes. And the second regime is, by design, only accessible to people who already have enough capital to make the structures worth paying for. It is worth pausing to acknowledge something. Every element of this strategy is legal. Every step is disclosed, at least to the institutions that handle it. No laws are broken. No filings are falsified. This is not tax evasion. It is tax avoidance, which is the polite term for using the code as written to produce the lowest possible liability. But legality is not the same thing as legitimacy, and the distinction matters. A system can be technically lawful and still produce outcomes that very few people, if forced to design from scratch, would deliberately create. A system where a teacher pays a higher effective tax rate than an heir to a timber fortune is a system that has drifted far from whatever original intent the writers of the code may have had. There have been attempts to close parts of this structure. Proposals to tax unrealized gains at death, ending the stepped-up basis. Proposals to treat large loans against appreciated portfolios as deemed sales. Proposals to impose a minimum tax on billionaires, calculated on wealth rather than income. Each of these proposals has been studied, debated, and defeated repeatedly across multiple administrations. The defeat is not an accident. The wealthy and the industry that serves them spend enormous sums protecting this structure. Lobbying disclosures show hundreds of millions of dollars annually directed at tax policy, estate tax in particular. Industry groups representing family offices, private banks, and ultra-high net worth advisors maintain permanent staff in Washington whose entire job is to ensure that Section 1014 and its many cousins are never seriously disturbed. There is also a softer layer of defense, which operates through public messaging rather than direct lobbying. Think tanks produce papers arguing that the stepped-up basis is necessary to preserve family businesses. Editorials appear in major newspapers, warning that any change would destroy American entrepreneurship. The arguments are sometimes sincere and sometimes strategic, but the effect is the same. The public conversation rarely gets close enough to the mechanics of buy, borrow, die to generate the political pressure that would make reform inevitable. This is the second uncomfortable truth of this investigation. The tax code is not a neutral document. It is a political artifact, shaped continuously by the people who stand to gain or lose from its provisions. And the people with the most to gain from the current structure have for decades been very, very good at defending it. So what does all of this mean for the person watching this video, who does not have a portfolio to borrow against, and whose estate will never approach the exemption threshold? It means, first of all, that the system is not what you were taught in school. The civics class version of taxation, where everyone pays their fair share into a common pot, describes a country that does not exist. The real system is two-tiered, and the upper tier has been engineered to be nearly frictionless. It means, second, that wealth accumulation strategies marketed to ordinary earners, the 401k, the index fund, the slow and steady approach, are playing a different game on a different board than the strategy used by the wealthy. Those instruments are excellent, relatively speaking, but they operate inside the taxable zone. Every distribution, every rebalance, every withdrawal generates a tax event. The wealthy play above that layer, where tax events are optional. It means, third, that understanding the rules of the actual system, not the cartoon version, is the first act of financial self-defense. You do not have to love the structure. You do not even have to accept it as fair. But if you do not see it clearly, you cannot plan around what parts of it are accessible to you, and you cannot form an informed opinion about what should change. And it means, finally, that the next time someone tells you the wealthy pay most of the taxes in this country, you will know to ask the follow-up question. Most of what kind of taxes? Calculated against what kind of denominator? Because the share of federal income tax paid by the top bracket is a real statistic, and it tells you almost nothing about the share of actual wealth and economic gain that those same households manage to keep outside the tax system entirely. The ledger, in the end, is not about villains. It is about design. And if you have followed the 3 moves tonight, buy, borrow, die, you now understand the single most consequential piece of financial architecture hiding in plain sight. If you want to see the next layer of this system, where the same logic is applied to entire multinational corporations, moving profits through jurisdictions the way private banks move portfolios, there is an investigation on this channel dedicated to exactly that. The link is in the description, and it is the natural next file to open after the one we just closed.